Welcome back to Wall Street Beats. Today is December 13th, 2024. We're looking
Friday the
forward to the
13th. You
holidays.
missed that one.
That's right.
Yeah.
And we're winding up, which appears to be a pretty good year, right? The S&P 500 to date, somewhere between 20 and 30% after doing about the same last year. Surprises me, and I'm a tech analyst. But I am Paul Meeks. I'm moderating today with two of my teammates. We have Nadine Turman and Charlie Peabody. So we have an interesting tale. I'm sure today will come up somewhere in the conversation. Costco reported this morning. And also one of my favorite tech names, and it's making me look good today, Broadcom, ticker symbol ABGO. So let's lead with Charlie. What say you this Friday morning?
Once again, I have a potpourri of items that I want to make
Financial potpourri.
Yes, a
Is it
financial
stinky
potpourri.
or nice smelling?
No, it's nice smelling. Actually, I'm going to start off with something stinky. As one of my themes that I've been espousing since August of this year was that things that need to be financed are going to disappoint. And by things, I've been talking about boats, RVs, homes, etc. And things like Polaris and Brunswick, which sell boats, have been very poorly performing stocks. The home builders, on the other hand, have held up relatively well, although they're starting to roll. And my shorts finally are making some money. But the reason I wanted to make note of this is this morning, JP Morgan downgraded three home builders, DH Horton, which I've been recommending shorting, Meritage, and I believe the third was Toll Brothers. And they downgraded them to sell. And that's highly unusual for the sell side to use that rating. So that I thought was very interesting. I have not seen the reports. I don't know what was behind their thinking. But my expectation is that gross margins were going to continue to be under pressure and that incentives would continue to be needed to move product off the shelf. And it's been interesting, we've had a very rapid backup in interest rates recently on the 10-year. And I think it was related. So when the CPI numbers came out the other morning, bonds rallied very quickly. The yields went lower. But then about 3 hours later or 2 hours later, you got the Treasury statement on their deficit. And that scared a lot of people. And you had almost a 10 or 15 basis point swing in yields that morning. And then yesterday you had the PPI that came out and it was a little hotter than expected. And so yields have continued to back up. So the bottom line is what I'm getting at is that rates remain sticky high. And that's very tough on housing because housing is an affordability problem. And then this morning we heard that maybe Trump is not going to eliminate the SALT, but compromise, maybe just cap it somewhere around 20,000 up from 10,000. So that's not going to help either. So I continue to play the theme that things that need to be financed are going to disappoint. Next week, we have a lot of housing data. We have the National Association of Home Builders Sentiment Index. We get existing home sales, starts. So there's going to be a lot of data. And then Lennar also reports, I think, around the 18th of December. I will point out from a technical point of view, we're coming back down. So these things have rolled over and have traded off. And we're coming back down to some technical support lines. So if the data is not bad next week and Lennar doesn't screw the pooch, maybe we get some sort of tactical bounce into the new year. But I'm still a seller that these things have a lot further to go on the downside. So I just wanted to update you on my housing thoughts.
So Charlie, earlier this week, you were giving us a little bit of the summary. I believe it was the Goldman Sachs banking conference.
Correct.
And one of the risks that you highlighted, which I thought was super interesting at the time, is you said that Scott Bessent, in his follow-on comments after being nominated Treasury Secretary, has supported all of Trump's policies, no surprise, but was pretty cagey about talking about the corporate tax rate going from 21% all the way down to 15%. And that could lead to disappointment. So yesterday, I'm following Trump's ringing the bell at the New York Stock Exchange. And of course, he gave a speech that went on for 20 minutes and it could have been easily done in 2. However, at the podium with Bessent right behind him, he hammered on that we are going to lower the corporate tax rate theme. And I didn't see Scott Bessent squirming behind him. And so Is he just continuing the campaign rhetoric? Is this impossible, given the budget deficit? But he really came back to that pretty hard in front of a lot of TV cameras.
Yeah, as Besson is viewed as a fiscal hawk. And so I think he's worried about that deficit, and I think the markets are too. Trump keeps us guessing. He makes a lot of promises, but we're not exactly sure what's going to play out in the first 100 days of his presidency. But I will tell you, that's the one question I get a lot from clients is, do you think he will follow through? And I don't particularly have any value added. I just thought it was noteworthy that Bessent didn't highlight that. He didn't say we're not going to do it. He just didn't highlight that, where he highlighted a lot of the other tax policies.
Right. One of the
But
things I thought was also interesting, and I didn't know that there was really this quid pro quo, at least in Trump's mind. He said, yes, we're going from 21 to 15% on the corporate tax rate, but the quid pro quo is you're going to have to build all your products here, which maybe goes without saying because it's a U.S. corporate tax rate. And of course, they're incentivizing domestic production. But it was the first time I heard that little slant.
yeah.
Mm.
And keep in mind, there are a lot of things he can do through executive orders or through regulatory fiat. But when it comes to tax policy, he needs Congress. And while the Republicans control both the House and the Senate, the majority is very slim in the House. And I think they lose, what, 3 people to his cabinet appointments.
Yep.
So when it comes to tax policy, if he's not going to follow through on the SALT agreement, then he's going to have a trouble bringing some of these states like New York and California over to his tax policy on cutting the corporate tax rate. So there is some horse trading that has to be done here before we get a better sense of
Yeah,
how it's
very
going to
interesting.
go.
Of course, next Wednesday is the Fed meeting, right? Isn't
Yeah.
it a foregone conclusion? Fed funds futures, 80-90% probability of a 25 basis point cut. But I'm wondering what Powell will say on the podium to the press afterwards. Because,
Yeah.
as you said, PPI data just yesterday was a little hot. And it's hard to go from 2.5% inflation to 2.0.
Yeah, earlier I had highlighted my expectation that there would be a cut. And I did that because the staff had recommended to the board that they cut the overnight reverse repo basis by 5 basis points, bringing it down to the lower bound. And it implied that there were some overnight funding stresses in the money market system. And going into year end, that's very dangerous to have those stresses develop. And so I think they really do want to cut rates in part to relieve that. I think there are other economic reasons as well, such as jobs data. I mean, if you looked at the household survey on the jobs front, most of the jobs that were created last month were all government jobs. Private sector jobs were shrinking. And I think jobs now are more important to the Fed than the inflation data. So I've been in the camp that they were going to cut. It's actually one of the reasons that I really liked buying gold stocks here. They had a horrible day yesterday, but I do think real rates are coming down as they cut and inflation remains sticky. And I think gold does well in that environment. But I continue to be a big buyer of the gold names. Paul, if you don't mind, I'd like to, in my potpourri of things this morning, I'd to switch over to a few observations on the Goldman Banking Conference because it concluded last night. Sunday, I published my preliminary fourth quarter estimates. I published those on the Wall Street Beats website. And if you look at them, you'll see I was above the street in some of the major names like JP Morgan, Citigroup, Bank of America. And I had a chance to talk to the banks individually yesterday and get a little more information behind the general guidance they gave for the fourth quarter. And I'm feeling very strongly that my estimates are absolutely the right place to be, which means the street has to come up. They have to raise estimates going into January. Now, the way the street usually does that is they call the companies like I did yesterday. They have their one-on-one meetings. They get some more individual guidance. And then they go out and change their models and they call their best friends first and tell them what the models are saying. And then somewhere in January 3rd, they actually publish those estimates. So I do think that you're going to get some strength in these bank stocks going into the new year. And that's been my anticipation. The one caveat there, and this is what makes it tricky, is the market itself and financial indices are very extended short term. We had an amazing year in bank stocks just in the month of November. They were up anywhere from 15 to 20% in 1 month in November. And as a result, if you looked at the weekly RSIs for things like the Consumer Finance Index, for the Broker Dealer Index, for the KRE, they were at decade highs of being overbought. I have to be careful about that, particularly within the context of an overextended market, that maybe the upside very short term is limited, but I really want to reiterate that the fundamentals are going to be very strong when they report them in mid-January. The one name I continue to highlight, and I had a really good call with yesterday, was Citigroup. I think you're going to find not only are their fourth quarter earnings going to be better than the street. I'm at about $1.47 for the fourth quarter, and that's core. So if they have some restructuring charges, I'm not including that in there because they are still in this restructuring reorganization mode. But I'm at $1.47. The street's at $1.22. When I talked to the company, I got the sense that street estimates were starting to come up after they gave guidance at the Goldman conference. And there are two areas that I think are going to really play out nicely. One is net interest income. The street was around 13.5 billion for NII coming into the quarter, coming into the Goldman conference. I was at 13.7, 13.8. I think that's good. Their street numbers are going to get raised there, and that's a source of revenues that tends to be higher multiple, and people pay up for that. So a positive surprise on NII is going to be positive. The other thing that they really reiterate is all the promises that they made at the beginning of this year are being met. And in fact, on the revenue side, which was a big question at the beginning of this year, they had guided towards 80 to 81 billion of total revenues for the full year, and they think they're going to come in above the high end of that range for the full year. And that's important because, and this is the last comment I'll make on Citigroup. You have to understand that this is a company that's had 3 or 4 management teams that have promised that under their tutelage, you'd have a turnaround. And 3 of those management teams in the past decade have failed to live up to their promises. And so when I talk to analysts or portfolio managers, they're very hesitant to buy Citigroup because they view it as career risk. In other words, if you mess up on Citigroup, which has a record of not meeting their expectations,
You're like you're the idiot kind of thing.
Yeah, absolutely.
Why did you go in that? Everybody knows that company sucks.
Yeah, and I have not been on board that train for the last decade, but I do think that Jane Fraser is the real deal, and that they are meeting their expectations. And I think as they build credibility, that stock is going to get re-rated higher. So again, I think fair value short term is in that $72 to $78 area. By 26, I'm looking at $100 stock on Citigroup. So it remains. They've got a lot of very good momentum coming into the new year, and it remains my number one pick. So I'll leave that there. But I think estimates are coming up on JP Morgan. I think estimates are coming up on B of A for the fourth quarter. So you're seeing good momentum coming into the new year. The question is, how much of that was anticipated in that strong November period?
Yeah, thank you. Nadine, what do you got for us today? I bet you might be talking about Costco at some point.
About what? Oh, yeah, we can chat Costco. We can totally chat Costco. They had more members. About 90% of members renewed their service, which is obviously pretty good for people sticking around. And as you mentioned pre-show, especially when you're jacking up prices, you like to see people stay. Same store basis, traffic rose, but the number of transactions was flat. And they were talking about, which I think is interesting. I think the CEO said people are very basic buying this year. So what translate that? What does that mean? Because that's a weird way to say it. Seasonal products selling well. Furniture has been driving e-commerce sales the holiday season. Consumers been shifting spending into food and groceries away from restaurants. Preference for premium and lower priced items, so like on the ends. They were just saying they're focused on value, obviously. The shares were not all that enthused just because there's just so much going into this print, but it's up 11 bucks now. So I think during the Q&A and talks, people get a little bit more excited.
Well, the stock was already up a huge amount year to date.
Yeah, but you're getting a bump today. This is not the day you go chase Costco, though, solid. I think, as Charlie rightly mentioned, you can go get your gold bars there while getting your tooth flossers and all that stuff. So a lot of people I'm not going to tell you which one Charlie uses, but Yeah. See, I'm just seeing if he's paying attention. Seeing if he's paying attention. But people are headed over there. But I actually was going to talk. I'm subbing here for our buddy Ben Bry. One of the things that we were talking on the Longbow show at 6 a.m. West Coast time today was just this persistence that we're seeing in tax law selling.
Are you trying to get
So
brownie points for waking up early?
Yeah, she had to throw
I
that out there.
should. Although I would like to get some brownies. I have not had breakfast yet, and my coffee, it's on the warmer, still not fully drank. But basically, you're getting tax loss selling in things where people didn't make the money this year or made very little. We're still seeing a lot of that. And initially, that's creating, call it post event. So let's say it's a earnings call or something, pretty good short opportunities. There was a number of that. We've been talking about Lovesac, you saw Play, there's just been a whole bunch. But at some point, so this is the so what of it if you haven't been short in some of this stuff, it's really going to lead to wildly oversold long opportunities before year end. Because if something doesn't go well, everybody's throwing it out. They're not going back in it. They got to wait 30 days. And so if you have dry capital, you could probably pick some things up. And we've been doing that, doing some really short term trades where, either of the two things that are well too loved that disappoint, getting hit way harder than it normally would given expectations and what people want to hold going to 2025, and then tax loss selling. But then the opposite end, getting that, I don't want to call it a dead cat bounce. After, I think you had a dog analogy, Charlie, earlier. I don't really want to have dogs and cats on the show, but basically you can pick up some names here where everybody's throwing it out. We've been doing that, collecting some nickels and dimes in the last couple of weeks, and we continue to see that as something that people could do if they're looking to make a little bit of money sitting in their seat. The other thing, there's some NASDAQ inclusion deletion stuff going on that could affect MSTR. I don't want to get into the Wall Street beats, love and hate it, MSTR business, but you can go check out our video. We talked a little bit about that. Yeah, so there's nothing that I saw as super actionable today, just on the technical side. But I did note that there's a lot of bond-related names on our top lists here for asymmetric trades. So when you see that, those also can be, if you're collecting nickels and dimes while you're waiting for big moves, that's something that you can look into if you have a fundamental thesis on that, which goes to also gold. Interesting, Charlie. So you've been buying. What's the timing on your gold call?
I think you're going to see a good move into the new year, into January. It's my
It's pretty
And
short.
Charlie, the other day on the show, you gave us a gold individual equity, not an ETF or an index. What company was that?
the two quality names are Agnico Eagle, AEM, and Ashanti Gold, AU. So those are the two quality names. If it depends on your style. If you're a contrarian and you want to pick up laggards, American Barrick, which has some geopolitical issues, and Newmont, which has some production issues, are laggards. The one that I mentioned 2 days ago was Pan American Silver, PAAS. I really like the silver names as well. So it depends on your style. Paul, can I make some observations about? I've talked about this market being extended, and I want to represent
No,
Ben
you're
Bryant.
you're, you're done. You're done.
I,
All
I,
right.
I definitely done, but I'm here
Please,
representing.
Done.
I'm representing
Done.
B2
no
Ben.
reason to even ask. Please, brother, go ahead.
So there are two things that Ben has posted recently that I think have been making the rounds.
Don't fill
One
his
is,
head. Don't fill his head, Charlie.
sorry. I think he's brilliant, but there's a chart on consumer confidence in the stock market rising to the highest level in decades. I think it goes back to 1988 is the chart that I've seen, and we've generally never been over 50%, but we're close to 58% of consumers think that have rising confidence in the stock market, and typically it's because stocks go up, they get more confidence. But it does say that there's tremendous enthusiasm in the market. And so with that in mind, I want to read something that Tom Petterfy wrote yesterday. And as you may know, Tom Petterfy is the chairman and CEO of IBKR and Interactive Brokers. So this is what he wrote yesterday. So over the last 3 months, our margin loans are up by 16%, and which is rather, it's a bit, if you ask me, because, so he gets a little fuzzy here. If you ask me, it's because I think that equity prices are somewhat overextended. And by the way, Tom is a very straight shooter, so he calls it as he sees it. And I hope that as they come down, they will not come down too fast so that we can liquidate as it happens. And we will not end up with holding the bag of from people who are unable to meet their margin call.
Oh no.
And
Don't give them the margin. What? That sounds terrible.
um,
It's like we're driving really fast and I know the cliff is there. I'm pretty sure we got our brake service last year, but I don't really know because they don't feel so good. Come on in, right?
and the other
Yeah.
comment that I think he meant is how concentrated it is in the Mag 7, the margin calls, the margin position.
Yeah,
Yeah.
for sure. You want more stats? Because this is going out in my arrows note this morning. There's a deterioration in breadth. Obviously, I got a nice little chart there from B of A that the percentage of companies outperforming the SPX, like the SPY itself, is similar to the low levels of the late .com era. So we're at that
Oh boy.
31%. And then you've got, even with that narrow focus, I've got a whole list of all the flows coming in, right? Where they've been going. Crypto, obviously, number one, then bank loans, leverage funds, small cap, US large cap, corporate IG, high yield. Yeah. So they're flowing out of treasuries, going into high yield. So all of those things also tell you people's risk profiles, right? And I think that you're seeing stats about, oh, margins are going to be great, and that doesn't happen. It doesn't go to the moon. And you're seeing that in some ways. It's not just like the shooting of the healthcare CEO. Is you look at, obviously there's been a ton of studies and research out. It's not just the healthcare portion, but when you see companies getting so fat and their margins at huge levels, the anger from consumers, right? And
Yeah.
whether it's just eggs or whatever it is, it's like, why is everything so expensive? And so companies can't keep pushing that. They cannot keep pushing that. And you
no,
don't just have volume go down by a little. If they've taken out amazing margin loans on their stocks, those go down. It's going to hit everywhere. So you never know when the party ends, but you certainly are seeing this party being a little bit too big of a rager for us boring folk.
and I would not underestimate if we do have some sort of hiccup, and I'm not sure what would cause it, but let's say we do have some sort of hiccup in the markets. People are looking to the economy to justify buying financial assets. I think it's the opposite. If we get some sort of hiccup in financial assets, then I think that negative wealth effect is going to play huge on consumer spending. And that has
Totally.
been my quote unquote fallout from a home housing market correction is it's not going to hurt the banks. The banks have done a really good job of underwriting for residential real estate. So I'm not worried about the bank's capital being impaired. But I am
Yeah.
worried about the negative wealth effect because that's your biggest asset.
Sure.
And so if we do get deflation in home prices, which I think we are headed towards, that's going to have a huge negative wealth effect. And then your second biggest asset is your market, your 401k or your pension plan. And so I think there's a feedback mechanism from a negative wealth effect back to the economy and specifically the consumer spend. And we've already seen, as I mentioned, B of A is talking about consumer spend having slowed to
Yeah.
4% here in the fourth quarter. And that's down from high single digits earlier this year.
Yeah.
And then I think the high end, as Toll Brothers is telling you, as the lack of spending on luxury goods and experiential, the slowdown, I shouldn't say lack of spending, the slowdown in spending for luxury goods that B of A is highlighting from their consumer data is saying the high end is starting to pinch pennies.
Guys, let me close out the show with something everybody expects me to talk about. Broadcom, symbol
Please do.
ABCO,
Yes.
reported last night, absolutely smoked it. I'm not going to go through the details. I'm a happy owner. But I will tell you this. They reported their Q4 yesterday. And so for fiscal 24, they did $12.2 billion in A-centric semiconductor revenue. And this is not an apples to apples. They're talking about not what they will do, but they think that in fiscal 27, only 3 years away, that the TAM, total available market for that product will be somewhere between 60 billion and 90 billion.
Sorry.
So
Wow.
they're not saying that's what their revenue is going to be, but you think even if they were to maintain share, oh my goodness gracious, that is another very powerful data point for continued AI infrastructure build. So I do that name. The last thing I'll say is I've mentioned this to some of you folks before. We've been together for quite a while. It is my favorite story about Costco, and it shows their absolute allegiance to their customers. I once, as a portfolio manager, went to meet with the CFO, and we were about a 3 or 4% shareholder, which is pretty big. And he would not shake my hand at the beginning of the meeting because when he asked me if I was a Costco member, I said no.
That was just his excuse, Paul. That was his excuse. There
That
were
was
other
originally intended,
reasons.
and
You're
then
not
when I
going
was
to go
driving
into
back
it.
to the office with my team, I said, "Oh my God, that's pretty
That's tight. Actually, I'll give
Hey,
you a
Paul.
nugget. Look on Bloomberg and put in Costco, the stock price, and then also the XLV, the healthcare
yeah."
ETF. They look like the
Hey,
opposite since the fall.
hey, Paul. Can you, going back to your Broadcom comments, because they were very robust, what differentiates Adobe from Broadcom? Because people are looking at Adobe's shortfall as
Right.
a canary in the coal mine on the AI front. Is that
Yeah,
false?
so
Adobe problem.
Broadcom is a tweener. It is 60% sales semiconductors, 40% sales VMware, which is infrastructure software. Whereas, of course, Adobe is essentially an enterprise software company. I think, because I also followed Adobe's results, I listened to the webcast live, that there is an equal chance that they will be disintermediated by
Yes.
AI, not
Mhm.
benefiting from it. And I think the same thing of some of these other ERP software companies, a la Salesforce, which I think is way too expensive, and even Oracle. And I stay with the infrastructure builders because I don't believe in enough of these software companies that are purportedly to benefit from AI. And so that's one of the distinctions, Charlie. And also, I think, particular to Adobe, within a software space that I don't like anyway, I think they're particularly in trouble because AI visualization tools go right into their sweet spot. And I don't know if they're going to have a good enough response. I would be tempted, you would be tempted to buy it down so much, but I don't know, man. I think there's sufficient
It's not
product.
even the response, it's just that other people can do it too. So the
Yeah.
moat that used to be there, Charlie, was like the training of people, the subscriptions. No one else had that software product. And now you can see so many other tools you can use, many free or
Yeah.
super cheap. It's a really different business with, I think, as Paul's saying, different prospects.
Like any stock, it'll get too cheap at some point. I
Sure.
do think the company's pretty well run, but I still think if you're going to play AI, which if you're a tech investor, you absolutely must, that one's still on the avoid list for a while. It could go lower.
Do you want a fun nugget, a local nugget here to close
Yeah.
out the Friday? People are
Yeah.
pissed. Facebook is not having holiday parties. So I'm getting phone calls of so everybody's like flush with cash, having a good time, going out to fancy meals, but their employers are skimping. I think that
Uh,
they don't want to have parties maybe when they're letting people go or whatever. They're not really giving good reasons. But yeah, there's no Coldplay concerts going on or that kind of
they're
dog
directing their
massage parties. Yeah, none
they're
of that's
directing their
happening.
funds to the Trump inauguration party.
Yeah, looks like Amazon's going that way. OpenAI, they're all
That
giving
is
that
it.
money away.
Is
But
that
All
a
yeah,
right.
isn't that kind of crazy? Isn't that
is that
crazy?
a
Yeah,
is that
everyone's
a
so rich, but
record
they're like
sellout?
mad at their employer treating
That's
them
a
like they're
nice
poor.
anecdote. You guys, that's all the time we have for, man, I think we had a good show. Even had a couple laughs along the way. I'm Paul. She's Nadine. The other fellow there, the good looking guy without the glasses today, is
Charlie,
Charlie. And we will see you
Charlie.
next.
Bye
Thanks,
bye, guys.
Paul. Well done.
Thank you.
Thanks, Jan.